Good morning, everyone. My name is Tosayee Ogbomo. I am the Managing Director of FSDH Holding Company. I hope we are all well and keeping safe and adhering to the COVID-19 protocol, given everything that's going on in Nigeria and in the world right now. First, I want to welcome all of you for taking the time out of your busy schedule to be with us today, and to thank you for the privilege to listen to us. But I also want to thank our panelists for agreeing to grace this inaugural occasion with their presence, their time, and their intellect. I want to start by thanking Mrs. Titi Adeoye of Sankore Asset Management. She has built a pretty solid asset management business in Nigeria against all odds. I want to thank Mr. Yomi Jemibewon, somebody I admire from a distance, and in a very tough fundraising environment, was able to close a private equity fund last year. And it was a tough environment given everything that was going on, but Yomi and Femi pulled it out. Congratulations, Yomi, and it's an honor to have you with us. And then last, Mr. Toyin Owolabi, who leads our FSDH Prestige banking business. Toyin is a seasoned banker and has been a trusted advisor to a number of financial institutions and individuals in Nigeria. And Toyin, thank you for agreeing to share your wealth of wisdom with us and the participants. I also want to thank all the members of the FSDH family for the support you've given our new child, FSDH Fairpay, FSDH Bank, Merchant Bank, FSDH Asset Management, FSDH Capital, and most especially FSDH Power Pensions. Power was instrumental to pulling this platform and webinar together. The key reason we restructured FSDH into a holding company was to allow us broaden the services and products we offer in the financial services space. And FSDH Fairpay is the first of many of those initiatives. It's the first subsidiary that's coming out of the FSDH holding structure. And FSDH Fairpay is a digitally led, digitally driven platform for the distribution and innovation of financial services products across the spectrum. And Mr. Igwe, who was part of the leadership team of Bain consulting firm in Africa, was tapped to lead that effort. He has significant experience in financial services, and he's been tasked with driving the innovation and strategy from FSDH Fairpay. In the second quarter of this year, FSDH Fairpay will be launching its first product, Vested, and Obi will take some time to share his thoughts on Vested in a minute. But again, thank you all for taking the time. I think you'll be hearing more from FSDH. And with that, I turn it to the CEO of FSDH Fairpay, Mr. Igwe. Obi.
Thank you so much, Tosayee. Good morning and welcome again, everyone. Thank you so much for joining us. It is a pleasure to meet all of you virtually. I do hope that soon we can do such sessions in person and hopefully more pleasant circumstances as well. As it is, the physical and mental health challenges that have been brought by the second wave of COVID-19, both in Nigeria and also in other countries that have large Nigeria diaspora populations. So I know many of us on this call, for example, that family in the UK and the US, mean that many of us really are living in a state of near constant anxiety. So, that's tough and it's completely understandable. And I think the situation is then further kind of complicated by what is a dire economic reality, right? So I think last year there was a contraction of the economy, and this year the expectations are that real GDP will grow at a rate of about 1%. Consumer inflation will be at around 16%, and experts also expect a gradual devaluation, right? And so this basically paints a very sort of dire economic picture. And to make it more concrete for some of us on the call who think in terms of Naira and Kobo, right? So during the 1 month that we spent settling into 2021, as it were, every one of us on this call who maintains a stash of cash at home, say in a secret jacket pocket or in a traditional current account that doesn't earn any interest, has lost about 1 kobo of purchasing power for every Naira in that stash of cash, right? So this is not a very sort of positive time for savers and for particularly risk-averse investors. So I think today what we really want to talk about is, how do we get the balance right between indulging what is an understandable tendency towards conservatism, when in the midst of uncertainty. So get the balance right between doing that and taking some actions that actually require to preserve wealth. So it's a tough question. We admit that. However, we're confident that we do have a panel today that can do justice to these questions. One thing I should say is a quick disclaimer, is that our panel today can provide some high quality perspectives. They are very experienced. And while the perspectives are helpful and directional, they do not constitute financial advice. Right, so just a quick point to note. Yeah, so let me introduce our speakers. I think Tosayee had mentioned, or I talked about them briefly earlier. So we have 3 esteemed panelists with us today. I'll start by introducing Mrs. Titi Odunfa Adeoye, who is the CEO of Sankore Investments. Titi's area of expertise is in asset allocation and portfolio optimization across a range of global assets, with a focus on strategies for the creation, growth, and preservation of individual or family wealth. In addition, Titi has strong expertise in alternative asset classes, for example, venture capital, real estate, and agriculture, due to their higher potential for financial and social returns from these kinds of assets. She's an active venture and angel investor across various sectors, particularly those that impact wealth building in Africa. Prior to Sankore, Titi gained experience in investment strategy and consulting at Goldman Sachs, KPMG Consulting, and PricewaterhouseCoopers, as well as Zenith Capital. She has an MBA from Harvard Business School, a BBA in accounting from Howard University, and is a certified public accountant. Serves on the boards of FCMB Pensions, Carbon, Centurion Registrars, Saunders Development, She Leads Africa, and the Nigerian Higher Education Foundation. Welcome, Titi. We'll also be speaking with Mr. Yomi Jemibewon, who is MD and Managing Partner of CardinalStone Partners. CardinalStone is an asset management firm that currently manages $250 million across various asset classes. Today, Yomi co-heads CardinalStone's private equity business, where he invests in and guides small to medium scale businesses towards positively transforming the West African economic landscape. Yomi has worked as a management consultant in the New York office of Bain & Company, so also a Bain alum, as am I, and is a research engine and as a research engineer with Motorola in the US. He earned BS and MS degrees in electrical engineering from Virginia Tech and an MBA from the Wharton School at the University of Pennsylvania. He's also the author of a very compelling book called Risk and Return, which I found useful. And I read it last year. And it's a book which chronicles a return to Nigeria and the entrepreneurial and life journey that ensued thereafter. And finally, we also have as a panelist today, Mr. Toyin Owolabi, who is the head of prestige banking at FSDH. Toyin is a very seasoned banker, has about 20 years of banking experience, and is a group head of financial institutions, correspondent banking, and wealth management for high net worth clients at FSDH. In his role, Toyin is responsible for developing and managing relationships with all non-bank financial institutions and other institutional clients. Before joining FSDH, Toyin worked at FCMB and at different times oversaw financial institutions, correspondent banking, and structured funding. He was also the head of treasury at IMB International Bank. It's good to have you, Toyin. Yeah, so just some quick housekeeping before we start the session. So following the panel discussions, we'll open the session up for questions from our audience. We're encouraged to share these questions using the chat feature in the Zoom video conferencing app. But even before that, we would like to keep the session interactive. So even while we conduct the panel discussions, please do feel free to leave any sort of comments or reactions using the same chat feature, and to also use the reaction emojis. So you can use the thumbs up feature or the clapping emojis as liberally as your personality would allow, right? So whatever feels comfortable. You might want to give it a test now. So I just did a bit of a raise hand feature, and so you might want to clap or respond in some way. We'll take a short break as well in approximately 30 minutes, during which we'll sort of do a short straw poll, and we'll ask you if you sort of snap questions. And so without further ado, we shall get into it. So Titi, I suppose starting with you, it's be good to know, and actually I think I'll pose this to all of our panelists, but perhaps Titi, you can respond first. What is your personal investment philosophy? So how do you personally think about investing? And then as a quick follow-up to that, how will you adapt that philosophy in 2021, which promises to be a special year?
Again, thanks so much for having me. And that's a good question. Everyone sort of has a different way of thinking about it. I think my personal philosophy is I definitely think about, first of all, how do I plan to create wealth, right? And then I think about how I want to manage it. So I think about those two things separately, because I think a lot of people focus immediately on, okay, what is my investment strategy without even thinking about what is their wealth creation framework, right? Mm-hmm. And that is something, especially when I'm speaking to a lot of young people, and I define young very loosely, you know, between the ages of 20 and 50. I always say to them, like, how do you intend to create the wealth that you want to manage, right? So there are really three key ways. Do you intend to be an employee who raises up to be a top executive at an institution? Because that's a very strong way to create wealth. Do you intend to be an entrepreneur? That's a great way to create wealth, but very risky. And I find that a lot of people don't realize that there's actually another way in the middle, which is intrapreneurship, like coming into a company and helping them build a new business. So it's kind of like the best of both worlds, where you have the safety of being an employee, but then you also have equity upside. So I actually encourage people to start with that. Think about your wealth creation framework, right? And then once you're clear on that, you now think about the specifics of the income you want to manage, because depending on your wealth creating framework, it will actually affect, you know, just sort of what your plan is, right? So you'll find a lot of entrepreneurs put all their cash in their business anyway. And for those ones, it may make sense because they're temperamentally aggressive investors, and they probably have a bit of an all or nothing approach to investing, right? So when we see those people, we understand that based on their wealth creation framework and based on their risk tolerance, this is how they intend to invest. So for most other people who are not entrepreneurs, then you can now start to do the typical, what is your plan, right? What is your long-term objective? That's one thing people don't do enough of, is thinking long-term. You know, people are just like, okay, what is the most interesting thing I should do right now, right? Think long-term first, set long-term objectives, then create a plan to meet those long-term objectives. So the summary is, be clear on your wealth creating framework, then come up with your investment strategy. And then the second question that you had is just about, you know, okay, how does that now apply to 2021? 2021 is, we think of it as, of course, it has to be better than 2020. That's a low bar, but we don't think it's going to be fantastic. In fact, we think there's more downside risk, because everyone is actually going into 2021 with this attitude of just get me away from 2020. It's going to be great, fabulous. The only thing is, Nigeria at 1 to 2, best case 2% growth is nothing. So we will still be in a situation that it's not at the best of all worlds. So your strategy in 2021 also needs to be one that is cognizant of that. You've got to realize that, look, we're still just trying to get out. In fact, remember, before coronavirus, we were still trying to get out of the previous recession. So it's still a difficult time, right? So if you do have some money to invest, inflation is high and so on and so forth, rates are low, you may actually at this point, especially with, the amount of your allocation that's fixed income, want to be a bit more on the short end, because hopefully interest rates will rise a bit more, right? And then I always tell, especially younger people, take some risk. Especially in a country like Nigeria, you should be thinking of alternatives. You should be thinking of investing in some way in agriculture, private equity, venture capital if you can. A lot of people, and by the way, it's not typical, in a lot of other countries, you hear people say, oh, only highly sophisticated people should invest in venture capital and private equity. I'm of a different belief. I actually think that because of where we are in our country, and because of the fact that we all need to use our wealth to build this country, we should all see it as our responsibility to invest, And by the way, these countries that we admire, that's what they did. They invested in their railroads, they invested in everything in those days. Even retail investors did that. So we're definitely believers that young people need to be aware that there's actually a responsibility to having any sort of wealth. And that responsibility is to invest in the wealth building of this country. So long story short is, fixed income, short side, alternatives. Stock and equity did really well last year. We always recommend a long-term allocation to a strategic basket of good stocks long-term, but don't expect much of the same. Typically when Nigeria has one of those blowout years, the next year is not as great. So it's a good place to always have some allocation, but we're actually believers in investing in more of the real economy of building new businesses than, the companies that are already on an exchange. So I would say that's my summary.
Thank you so much. Yomi?
Yeah, thank you very much. I'm gonna start by from a point where Titi spoke about entrepreneurs. So I'm an entrepreneur. I've been on this entrepreneurial journey for 12 years. So for the first 5 years or 7 years or so, I could not think about this because everything I had, leverage, everything was in CardinalStone. But what I'm gonna do is I'm gonna be very specific about myself, right? Because that's what you asked and that's what I do today. At any given time, my philosophy evolves based on 3 key things. Number 1, available savings. And initially I had none, right? Expected inflows and outflows, and then profile of accessible instruments or investment products. But there are a few things that have stayed constant. 1, it has to be low touch because what I do requires a lot of my time. So I can't be focusing on those things. So that's a requirement. 2, there needs to be some level of safety. I didn't have safety before. My family didn't have safety. So safety started becoming, look, there needs to be a safety net. 3, I do have a high risk tolerance, but recognize I started as an entrepreneur, everything in one bucket. So 4, I needed to start thinking of diversifying a little bit away from my bucket. So I think sharing with you the variables and the constants. I'll now talk about 2 phases that I've been through and the phase that we're going into. So 4 years plus ago, I had limited savings. There were high T-bill rates. So as the savings came, I didn't even want to think it was T-bills. You could get 20%, 18% safe. You knew if anything happened, you could call it, you could have it, So there was no thinking because stocks again, I couldn't do that, right? But then the last 2 years, T-bill rates have been dropping. Savings have been increasing somehow, somewhat. So what I kind of transitioned from T-bills to an advisor-led equities play. So sitting with an advisor and saying, look, I can't think about this equities market, but can you think for me about where there are good coupon, dividend coupon yield, dividend yields, T-bill coupons, or Euro bonds to give some dollar security. So it was about thinking about diversifying in a way where by the end of the year, sort of making up the kind of returns I was getting from T-bills with some level of safety. But I couldn't do that. I needed some advisor to do that. But recognize that that was around the time we were raising a fund. And as a private equity fund investor, I have PE commitments that I have to make. So also that limits how much I can save because I have to put some of my money into the fund. Then now, T-bill rates have even dropped further last year. And I think Titi talked about equity markets went up. Why did they go up? Because as a lot of institutional investors were getting off bonds, they had nowhere else to go. They couldn't go back into the bonds, so they were coming into the market, into the equity market. So again, I'm still sitting with the advisor saying, but for how long do we stay in this? Do we get out? But I can't think about it. So I've told them, look, end of January, get me out, because I can't be thinking about this. I have equity commitments coming up. So that's been my philosophy. It keeps on evolving.
Got it. And I suppose for you, as an entrepreneur, you take a long-term view. So 2021 is but a bump in the road.
Okay, so let me actually say that. So my view is a little bit different from Titi's. As an investor that does private equity, it's a fantastic time to invest. We think 5 years plus in any investment. We actually like the fact, well, let me not say this. Many businesses have been challenged. Many businesses are probably going to have a hard time attracting capital. Capital. Please come to us if you have a good business. We can equip you and support you to develop and grow and outcompete your peers. It's a really good time to take a medium-term view.
Makes sense. And Tony?
Yes, well, thank you very much. I think the two speakers, Titi and Yomi, have done quite interesting expositions in this regard. But for me, I'll say personally, based on where I am at any point in time, my philosophy as would I call it, diverted in terms of what intention is. I start with my goals all the time. When I was pretty young, I barely had any savings. So all I wanted to do was buy a car, rent a place, buy a few clothes and you look good. So at that time, investment was the little that I had that I put aside, and I put it in the stock market at that time, just something small, so that I could also point to some investments based on the little information that I had at that time. So I just always put a little bit aside in the stock market, and I have been a risk taker. As a young man, I was quite a risk taker. So I sometimes decide that, look, this is what I believe I should do. For instance, there was a time the stock market was booming, and I just threw in quite a lot of money into it. There was sometime in the 1990s. I lost all the money. So it was an experience for me. It was an experience for me because I didn't understand the market. So I shied away from that market for a while. Then, as I was growing, family became the next priority. So my goals changed at that point, and I started looking at putting something aside, for the future of my kids. Then I opened a savings account, and I realized at that time that, look, the way Nigeria was going, most people were going to send their children abroad for school. So I started to put some money aside. I opened savings accounts for the children as soon as they were born in foreign currency, and started to put something aside a little bit because the exchange rate was very woeful at that time, but just something to put aside, for quite a bit. And then at some point, I felt that the money I was making as an employee wasn't sufficient to take care of the goals that I had. So I left banking. I went to try my hands on something interesting. I partnered with someone to build a mechanic garage. tried to put my education into it, financial planning and all that into the business. And, you know, in a little while, I decided it wasn't for me. I mean, partnership, that is not the business itself. And I went back into banking. So at several times in my career, I have taken such leaps. Today, I think it's a bit different. Now my kids are in college, and I believe that the next way for me, or rather the next approach now, is to settle and try to preserve some wealth. You know, I mean, my daughter and I just 2 weeks ago were talking about her future, and she was like, look, she doesn't think she should save this much because she had to spend. And I was like, no, don't worry about it. You save what you have. When you finish school, we will get together and buy you a property. You know, all you have to do is commit to providing the initial deposit. I will contribute to it, but you won't live in it. You will rent it out, and then you go live somewhere else and work. So basically, what I didn't have, I decided to pass it on to my kids in terms of financial knowledge. So at this stage in my life, I'm looking at how to preserve what I have and how to pass it down to my kids. And that's my philosophy at this point.
Makes sense. Thank you, Tony. So I suppose that it's sort of a good transition to my next question for you, Titi, which is, you know, there are no, and I think we can all see this from the responses to the first question, there's no investment strategy or philosophy that works for everyone. But if you were to generalize, right, and you look at people in different life stages, so you look at someone who is a single Gen Z versus someone who is a Gen Xer with kids in high school, versus someone who is in their 50s and who has sort of mature kids. You know, what are some of the things each of these life stages should be thinking about as they invest? How can they sort of formulate investment strategies, just sort of a broad guideline?
So I think what you said at the beginning is the key thing, is definitely, typically strategy is very specific to your individual situation. However, you do find that even after you go through the work of understanding individual objectives and so on and so forth, you can see similarities in, you know, different model portfolios that you can then say, okay, well, there are some generalizable rules. One generalizable rule is that it's always important to have liquidity. So you think of that as sleep well money. At any stage, whether you're an entrepreneur, an employee, it's just, you know, based on your wealth creation framework, as I said, it may change the amounts you have to invest, right? Mm-hmm. But regardless, you should start, most likely just start with your base of liquidity, right? And by the way, that's something we as Nigerians do not do well. So in the last 11 years of us working with high net worth individuals especially, we find that 40 to 60% of their assets are held in real estate. So you end up seeing this situation where the average Nigerian high net worth individual is high net worth but cash poor, right? It's because they're not following that first rule, which is that you should ensure that you have liquid sleep well money. So that means that regardless of your risk tolerance, there should be this base of fixed income that just sits there and is your long-term uninteresting money. Because, you know, it's, the younger you are as well, you kind of want all these things that move around a lot and you are hoping for money to double and so on. Thinking like that is definitely something that could lead to you losing money long-term. And so we think of that as just sort of the lottery mindset. And the lottery mindset is very bad for wealth building long-term. So that rule of sleep well money, if that's one takeaway, just keep that in mind. Sleep well money doesn't double. Sleep well money doesn't, you know, it's there so you can sleep well, right? And we're lucky that in Nigeria, average yields, you know, especially if you go longer term, are north of 12% long-term, right? So one of the things I also see that people don't do enough is buying bonds, you know? So when you see bonds at 16%, that's where you should be locking down that rate and buy a 5-year bond or a 10-year bond, but people don't typically do that. The most popular tenure for most people is 90 days because everyone wants to just be short. So definitely that liquid exposure is first. Then another generalizable rule is once you have your sleep well money, now take some calculated risk, right? And now question is what buckets are those and what weights, right? So in a place like the US or the UK, where stock markets are large and liquid, most of that cash just goes into the stock market. We have to realize that Nigeria is not the same and stock markets operate a bit differently here, right? So we always think as the replacement for those should be things like agri-finance and even elements of private equity and venture capital, especially if you can manage the risk where the exposure for the average retail client is probably, you know, just sort of, number one, very small, but then number two, there are ways to have exposure to that asset class via lending products and so on and so forth. So we actually still believe that retail can do it if it's done, you know, just sort of properly and in the right measures, because the overall impact on just the country is just great. If you think about it, you know, the average investor in the US is just told to put 50% of their money in stocks. Our stock market cannot do that, right? Our stock market, most of the stocks there are not, I mean, the economy is not growing, right? So you can't actually recommend that because we don't even have enough companies, you know, built and trading yet. So the replacement here should be for us to invest in the creation of these companies, of course, finding ways to manage that risk. But we definitely believe that if, and remember, you know, it is typical for us to say, oh, retail shouldn't. Guess what? Most Nigerians already do venture capital. They lend their drivers money to start a business. They lend their brothers money. They lend their friends money. Everyone already does it, right? This is a country where it's just part of the culture as well. You know, the friends and family around is that for a reason. And everyone does it all the way down, even more than in these developed countries. So we actually are believers that if there's a way where instead of you as an individual lending money to 5 of your friends, that you're likely never going to see that money, why not instead invest in a properly managed venture fund that gives you exposure to 40 companies, right? And then that way you're still doing, you know, the work of building the wealth of this country, which we all have to do, let's be clear. Sorry, going a bit long, but the key generalizable rule, right? Sleep well money. Then you can now look at your risk allocations, and that is dependent on your own risk tolerance, right? But I'm also bringing up the fact that this whole sticking the allocation from the West that says 50% stocks does not work in Nigeria. You have to look at the other asset classes, and alternative asset classes are the replacement. They're the things that help us create what, you know, our children will be able to invest in, which is now a vibrant stock market that has enough companies trading, right? So we really have to have people find a way to put money in agriculture, in venture capital, in a safe way.
Makes a lot of sense. And do you think that as one gets a bit older, the sleep well money sort of component should become larger and the amount of risk they're taking sort of reduces a little bit?
Exactly, and you'll actually see that in model portfolios. And model portfolios are just it's just a portfolio that tells you, okay, put of your total net worth, put this percent in this percent in that, right? So you'll see a model portfolio that you generically for a very young person will be different from a very old person. But of course, there's also individual risk tolerance. So I'll put that aside. But just on average, you'll see that a young person, you know, their sleep well money may only be, you know, 30% of their total net worth or 40, right? An older person will tell you, look, don't bother me about all that stuff. I don't want to hear story. Key thing is I've already made my money. I'm thinking of retirement. And for them, sleep well money may be 70, 80% at the top, you know, because at the end of the day, they are really more thinking of income, right? So income versus growth is a different thing. When you're younger, you should be trying to go for growth. When you're older, it's really about preservation and income, right? So it means that percent of fixed income should be different and remember I said those are general rules. You can also be a young person who has zero risk tolerance, and then your sleep well money will be majority of what you have, you know.
Yeah.
But, you know, just pointing out to people that, you know, some of these, there's a risk to you also just holding cash. You know, inflation is crazy high. You put all your money in the bank, earning zero in this country is not the best idea, right? So that's why if you can come up with a strategy that says, okay, I will keep this big chunk in cash, but because I've kept that big chunk in cash, I will now join an investment club and we will try to buy a property together. I will join a group and we will try to fund small businesses that we know about. I will, you know what I mean? Those are things that we have to be thinking about doing in this country that's different from what we see in the textbooks, right? Because the textbooks don't work in Nigeria. The asset allocations that we've inherited globally don't work in Nigeria. So when you take the Nigerian stock market and put its return and risk framework in an optimizer, it tells you to allocate zero. That's the country that we're in. It tells you that based on its return and risk characteristics, you should not put money in it. That's actually what it'll tell you. We, of course, find that that's just for the whole index. If you now pick a few select stocks, right, then, of course, it now makes sense. But that, and also if you have a trading mentality, so it's more of a tactical trading strategy. And that's not the case in the West. That's not the case in all the countries that all these books come out of that tell you put 50% of your money in stocks. It doesn't make sense here. So you really have to be thinking about creation of these entities, you know, and that's where all the alternative asset classes come in.
Thanks, Titi. Yomi, keen to get your thoughts. Titi sort of touched on, you know, how people can get involved, retail investors can get involved in venture capital and private equity. I wanted to get your thoughts on just practically, you know, how can retail investors engage in that part of the market while also sort of managing risk?
Yeah, man, Titi, thank you very much for pitching PE and VC, because yes, I think I think from your question and even from dovetailing from where Titi ended, first of all, why should people look at PE and VC? One, diversification. Two, higher risk-adjusted returns. And three, as Titi said, exposure into businesses and segments that you otherwise might not have had access to from the public markets or available products, or even have the capital to go into on your own. So who? The next question is, who should look at private equity, right? And I think I wanna take this from saying either individuals or a collection of individuals that kind of fit these two buckets. One, have built either individually or collectively a degree of cash or wealth to be able to participate in private equity or VC, given some of the factors that Steve just said. One, a typical PE fund would have a minimum investment of $1 to $5 million. A typical VC fund might have a minimum threshold of $250,000. And the reason why, again, I'm talking about the structured funds. And the reason why that's important is it's okay, you can collect yourselves together and fund businesses, but the PE and VC funds do a lot more than funding. They do a lot in terms of getting involved in guiding, chaperoning businesses, bringing a lot of value add to the table to ensure that they succeed when they get that capital. So I would advise people, where possible, either invest with a fund manager or have someone on your team that is going, invest with a group that has a structure to support businesses to succeed. So that's the first thing. There's a hurdle. The second thing is you have to be comfortable with the characteristics of VC and PE funds. And I'll name three. Number one, typically it is manager-led and the managers are independent. So typically those funds, you have to pick a fund manager that has a strategy that you believe in and that you've diligenced. Once you pick and you commit, they make the investment decisions. You don't come in and tell them, I like this today, I like that tomorrow. So you need to do your research. What do you like? What's your history? Who are those backing you? Do I believe in your philosophy? You need to do that work. Then it has extended illiquidity. Titi said it. Typical funds are have 10-year lives. You don't see your money, for maybe 7 years or so, because that's when you start getting returns back. So it's not capital that you want tomorrow or in 3 years. It's capital that you can kind of, put aside. So that $1 to $5 million I said, it can't be 50% of your net worth. It has to be a smaller percentage of your net worth. And then the final point that you have to be comfortable with is there's a J curve of a PE or VC fund, which is when you invest, for the first couple of years, there's usually a dip in value because there's a lot of work being done to prepare the company for growth. And it's literally maybe 2 or 3 years later that the value starts appreciating. And that's why the exits don't start until 7 years in. How do you get in? Number one, you need to educate yourself or yourselves, right? There are actually websites about PE, VC. There are websites about different local managers or regional managers and their associations, right? Second thing, you can join those associations and actually attend conferences. Third, you can actually engage advisors to advise you on the market and the asset class and which managers based on your propensity or your group's propensity you should be looking at. And then finally, you need to engage directly with fund managers or with entrepreneurs under a structure that works. My advice though, is if you were to invest in a fund, PE or VC, I would advise to join a fund that has some things checked off by institutional investors. Like when, if you were to invest in a PE fund or VC fund, look at who are those that have backed you already, how much are you raising? And that already does some due diligence for you. Many of those institutions, no matter how small or how big money they put in, they would have done some fundamental checks. There will be some governance things in place. So you can piggyback on those things, at least for your first 1 or 2 deals. So those are my thoughts.
Thank you, Yomi. That's very helpful. So one quick note to our panelists. Given that we're sort of speaking to retail investors, let's use a little bit less jargon so everyone can follow. So for example, yeah, yeah. So just a quick note. And so moving on to you, Toyin, the question for you: what are some of the government policies and programs that savers and investors might not be aware of that they need to keep in mind?
Okay. Policies that people might not be aware of. I think that help. Is it that help?
Yeah, that affect them.
Yeah. So.
Or that help or hurt, right?
Yeah. So we're talking about things like if you look at the Investment Promotion Council, for instance, the act that set them up actually allows them to take decisions as to what to allow. For instance, if you have an individual who has capital and is bringing capital into Nigeria, he can get a certificate of capital importation. So if you're flowing US dollars into Nigeria, for instance, and you want to go into a Nigerian business, you want to fund a Nigerian business, or you want to invest in the government securities, or for instance, you can get a certificate of capital importation, which allows you to take your money out without any issues, to take both your principal and your returns out. So that is that's something. And lately we've had this SEC and actually, yeah, the SEC, the stock exchange, talk about the minimum technology that is allowed for stockbrokers and the rest of them, whereby people's statements of accounts must come out every week or so that people are aware of what's going on and they can tell how their portfolio is performing. And yeah, you have that as along with even the research they've insisted that so research must come out from all these houses. This is to provide market information, so that you can aid decision making at any point in time. So once you have those, they have the market information, you have the research that talks about stocks and bonds and the rest of them that you should be looking at if you are a long-term investor or a short-term investor, whatever it is. And then you have your own portfolio to look at. So if you look at these three of them side by side, you could begin to look at making decisions. Then another one I need to mention is that of consumer protection, which is very, very key in the sense that in the past we've had people invest in the stock market, for instance, and the brokers done one thing or the other that is unethical, and they lose their money, or broker doesn't buy the stocks when he ought to, and things happen, they lose money, and they have nowhere to seek redress. The consumer protection law allows them now, so people can actually write to say, look, this is the issue that I have. The outfit has to respond to the satisfaction of the customer. And if the customer is not satisfied, the customer can write to the regulators to say, look, I had this issue, and this is the letter I wrote, this is the response I got, it's not satisfactory, what can you do? And immediately the regulator responds and helps the customer to seek redress. I think this gives confidence to investors. Also, the whistleblower is also a good one, because you see people doing certain things that are unethical. You quickly call out. So all this actually save investors. Talking about another thing entirely, we're talking about tax incentives also. I mean, we were talking about investors, people investing in businesses, agriculture, and the rest of them. There are some tax incentives for people who invest in agriculture, especially the technology part of agriculture. There's also manufacturing, mining, and things like that. So you have these tax incentives that help you to, or rather that reduces the burden. So, and then you have the pioneer status kind of initiative, which helps investors who are going into new areas actually have impact on the economy. Such help them to be grounded without adding pressure to them. It's interesting to know that, I mean, I found out because I'm the son of a farmer, that if you start an agricultural farm, so to speak, 20 kilometers or more from the source of electricity, roads, and the rest of them, you actually get some tax right back, so to speak. So it helps you to build rather than taking away from your returns at the point. So that's those are the some of these policies that are pro investors and
thank you so much.
Savers.
Thank you so much. That's very helpful. So we'll take a short break now, and during which we'll ask you to respond to a quick snap poll that should appear on screen shortly. So 5-minute break. Perfect. Thank you to everyone that took the survey. So I think about 70% of people participated. Interesting results. I don't know if everyone can see the results because I can see them. And the summary of it is, so we asked you to answer 3 questions, right? Let me share the results so everyone can see them. Yeah, and so 3 short questions. The first was, have we all set financial goals for 2021? 70% of us have done so. So we have a very motivated group with us today. So that's fantastic to hear. And then we asked, for those people on the call, what is your primary financial concern? And for about 70% of us, these percentages do not add up, unless people could select more than one option. 76 plus 38 is more than 100. But 76% of people essentially said their main concern is protecting their wealth. So it sounds like people on this call do have sleep well money. So that's a good thing. Shows that you're already taking some of Titi's advice. So that's something that we need to talk about, especially kind of inflation and devaluation in the second half of the session. And about 30% of people are more concerned about paying for large expenses, right? That's sort of a big concern. We added in a question there, which was a bit provocative around, personal debt, right? So do people have any outstanding personal debts or things like car loans or mortgages? About a third of people on the call do. And then of those that don't, about 2/3, about 6% of people do not intend to get one, which is interesting because I actually think this might be an interesting year to explore, creative use of debt in a controlled environment, right? If they can manage the risks adequately. So I'll just based on some of the feedback from the poll, I guess I'll ask the question and I'll pose this to Yomi. If everyone has seen the results, I'll stop sharing now. So Yomi, do you think that 2021, given the environment, right, so where interest rates are sort of fairly low, inflation is fairly high, should people within the right context consider taking on a little bit more personal debt in order to build wealth long term? What are your thoughts on that?
Well, I mean, look, I actually think it's a good time if you can access well-priced debt that can be fixed, that has a fixed rate. There's no better time to do that in Nigeria. And if you can use that to make investments that give you good returns, I think this is a good time. And I'll kind of tell a story. One of our portfolio companies last year, surprisingly, had its best year. And what kind of business is it? It's a granite quarry business in Akure. And what surprised us, when we spoke to the MD, he said, T-bill rates have dropped and people are not making the kind of returns with their money in the bank. So a lot of the projects that they've been putting on hold for a long time, they finally took out their money to make those investments. Because you see, one of the things about Nigeria or emerging markets is one thing that's a constant is, at least until we figure out a systemic solution, every 4 to 5 years, there's going to be some degree of devaluation if it doesn't happen immediately. So things like to do with real estate, equipment that you have to import and stuff like that. If the money you're earning in your fixed investments is not that high today, if you can get low, cheap debt today, it's advisable to actually bring your money, use your money to invest in things that in 2 or 3 years will be more expensive and costlier to do, or investments that can give good returns. So I think in answer your question simply, if you can, and I keep on saying if, because sometimes having access to these to this cheap debt is not easy, and 2, it's not always fixed, right? So honestly, I'd let Titi and Tony speak more to things about what their views are on what happens over the next year or 2 in terms of interest rates and things like that. But there's been so much change in the last 18 to 24 months. I can't predict on how fixed the low interest regime would be, but that's my response. I don't know if I answered your question.
Yes, you did. Tony, do you want to add something to that?
Yes, thank you. I think it's very interesting, but I'm of the opinion that this is the time to actually borrow. And borrow because, look, you can't. Okay, let me just. You need to know exactly what you're doing. Let's start with that. So you have to have done some research. So if you're borrowing to invest in treasury bills and bonds, it's going to be a big problem. So it's important that what you're doing is something that will generate sufficient revenues to cover the cost of your borrowing. Having said that, it is a good time for people to reprice their assets. I mean, you've already borrowed money and it's going, so you need to go back to the bank and say, look, interest rates are down. So you can reprice your assets, the loan, and then it will free you some money to do other things that you want to do. So borrowing is not bad in itself. It's what you're going to do with it that makes a difference. So I see people today who actually borrowing to complete some project that they've had and it's been too expensive getting funding. I have people who are starting these new businesses and they're borrowing to build capacity. So this is the time to build capacity because the cost of building is a lot less, is a lot less than what it was. And to be quite frank, the interest rate regime or this low interest rate is not going to be for long. Yep. The truth is, inflation is completely unbearable already. Then, I mean, we're looking at all the investments people make are far below inflation. So real returns is negative at the end of the day. So there's pressure also on the government to borrow, and I believe that's the reason. We're seeing interest in the unclaimed dividends and the rest of them, so that they can actually keep interest rates low. But interest rates being low is an opportunity to invest in manufacturing, like Titi had said earlier. Manufacturing and other alternative investments. Yes, agriculture. I mean, we're beginning to see fintechs on the back of agriculture. I'm seeing Farm Crowdy, I'm seeing Piggyvest and stuff like that, who are taking the initiative. Some people are, looking at storage in agriculture. How do you finance storage? Because we know that's where waste has crept in. So there's so many opportunities, but this is the time to borrow if you have a viable business. If you wait, it's unlikely that you'll be able to achieve what you set out to do. Yeah.
Thank you, Tony. And so back to you, Titi. I think one of the sort of main concerns, as we saw from the survey, for most people on the call is, how to preserve their wealth in the face of, rising inflation and unexpected gradual devaluation. What are some thoughts that you can share on this in terms of how retail investors can approach this?
It's actually a very difficult question to answer because of all these things that we've talked about, right? There's inflation, there's depreciation. And I think that's one of the reasons I always talk about this wealth generating framework. You know what I mean? Because imagine if you are just thinking to yourself, okay, my salary that I get every month, I need to preserve it. The key issue is you probably will not be able to, right? Let's remember that I, as someone who runs a registered firm, I typically try my best not to encourage retail investors to go out and hoard dollars, right? That's bad for, if everyone does it, we're in trouble in this country, right? So it's something that would be irresponsible for me to recommend to people. So that's why I always say to people, for preservation, you actually have to think to yourself, let me go back to how I create and build my wealth, right? Because if your monthly salary is not growing, remember, the generic investment strategy is going to say, put some money in fixed income, put some in stocks, put some in alternatives. Yields right now are low, inflation is high. For you to even beat inflation would be a feat. Right now, it would be very hard. Remember? So even if you have an allocation to private equity, venture capital, remember it's a small amount. Real estate doesn't yield that much in this country, right? Fixed income, I already said it's a long-term 12%. So you actually end up realizing that it is actually important for you to go back to thinking about how you build wealth, right? As one way to think about it, because it means that your monthly income has got to be increasing, right? So how do you ensure that that happens? Then so that's one level of it. Then for what you have, you may not always be able to beat inflation. To be honest, I've gone to a point where, we don't guarantee to people that, look, you can beat inflation. Sometimes you can't. Right now, inflation is super high, yields are super low. If you end up taking crazy risk, guess what? You lose your money anyway. So remember, the first thing I always tell people is that whole thing about sleep well money. That means I am a believer that you always hold fixed income. You know what I mean? So it means even now when T-bills and everything is at 2 and everything, I still am recommending you hold fixed income. So clearly I'm not recommending that. I don't have any recommendations that help you beat inflation this year. But remember, it's a long game, right? So if you are thinking long-term, right, then this year is a drop in the bucket, right? So I always tell, the advice that I would give is, okay, if you haven't done that so far, take this year to be the year that you actually decide to have a long-term orientation, right? And start to think long-term about things. So now if you want to beat inflation long-term, you need to set up a long-term portfolio. No more 90-day investments. For now, go short, but when yields go up, you now buy, longer term instruments so that you can then have the likelihood that you can beat inflation over a long period of time. And then, you now have a mix of different assets. You can put some stocks in there, you can put some alternatives in there. And, even for the retail investor, you can get some amount of dollars that you can put in your portfolio. But remember, hoarding dollars is also a losing game for people. People are still doing it right now at 490. If there's a close of that parallel and official rate, which may happen this year, you're going to lose a lot of money speculating, right? So it's also not good advice to tell people to run into dollars, right? So preserving, as I said, you really have to it's about being long-term. You can't rush into 2021 and think, okay, I haven't done anything so far and I want to preserve my capital. You can't this year, right? This year, rates are low, inflation is high. But now you have to say to yourself, how do I preserve my capital over 5 years or over 10 years, right? And that's a different question. That one you can actually do because inflation will probably not be this high. Rates will probably not be this low, right? So then you can now position such that your next 5 or 10 years can help you beat inflation. And that goes back to those rules that we said, right?
Yeah, so makes sense. So essentially, if you've never thought long term, 2021 is probably a good year to take stock and do so.
Definitely.
Makes sense. One last question for Yomi before we take questions from the audience. So as someone who works a lot of small businesses, I'm sure last year was a very interesting year for you and your portfolio companies. And so I'm sure many of the guys on the call and also from the survey are kind of thinking about how they can finance their personal businesses. And so I wanted to get a sense from you of what lessons you learned you're navigating last year that you take into this year and into the future in terms of how to finance sort of small businesses or how to sort of ensure that they remain stable in these very uncertain times.
Yeah, thank you. There are a few things I'm going to say to that. First, yes, last year was extraordinary in many ways. However, last year is part of what you expect as an investor. And let me say what I mean. Look, our CardinalStone story is going to be 13 years this year, and we've been through three real downturns since we started that journey, with the first one being in the first year when we started. And we've been through, I think, two major devaluations, but yet last year, we're in the middle of one that we're not clear of. So these are things that we've learned, that no matter how good things are, no matter how well things are going, I've learned to always expect in 3 to 4 years to deal with a shock. It's just that last year's shock was Corona, and it was a really big shock that we couldn't predict. So I think that's good context to say there was nothing surprising about that cycle, but it was just maybe the what and the how was what was new. That's point one. Point two, in terms of how do you finance new businesses, there's something Tony said that I agree with in funding growing businesses, but I always advise new entrepreneurs, avoid starting your business with debt. That's just one advice I have. You're going to make a lot of mistakes. You're going to learn a lot of lessons. And in fact, part of how you build credibility is showing the skin you put in the game to use to learn lessons. The best way to finance any business is through customers paying for service. So if you have a business that on day one, you can have customers that either fund your business for you because they pay for a service, that's always the best. Second, it's always good to have some seed capital that's either your money, family money, or close friends and family to start businesses if you're starting, because more likely than not, you're gonna make mistakes and there's gonna be losses. And so you kind of want a friendly, familiar face to deal with. Now, it's good that debt is cheap right now. So if you have a business that is really producing cash and cash flow positive from day one, by all means take that debt. Most new businesses are not doing that. But so what are some of the lessons we've learned from down cycles that we also applied last year? As soon as you see, first of all, every time there's an up cycle or things are going well, always expect a possible down cycle, one. Two, always expect some form of devaluation. So in terms of how you plan, how you strategize, what does that mean? That might mean, how much of my production requires importation? How insulated am I from when, devaluation happens? Can I pass that along to the customer? You need to be asking these questions as you're thinking about a business. Secondly, as you think an onset of devaluation or a down round is coming or something bad is about to happen, do scenario planning and have a scenario for the worst case scenario. There's a best case scenario, base case scenario, worst case scenario. It's okay, and you should have triggers that tell you when to move and act based on what you're seeing. And what that does for you is, and then cash is always king in a downturn. People always think about growth and investments. And like Titi said, you got to think about survival and just cash is king, because it's those that live through and survive the downturn that have the cash or the resources to build out of the downturn. And that's why a year like this, if you survived, if you have cash, if you were conservative, you can now take bolder moves. So even if you're starting a business in a downturn, be really thoughtful about conserving cash and being thoughtful about just survival and living through the downturn. Thank
you so much, Yomi. I appreciate that. Yeah, so I will walk through some of the questions that have been submitted in the Q&A box. Some of them we've already answered, so I will skip those. I think the first question is on how to manage inflation and devaluation. I think that's something that has been answered. There's a question here around, for young people, say a 19-year-old who is just starting out and trying to invest, what should they be thinking about? I suppose, Titi, I can pose this to you. It's probably, if you work with your framework, right, of having some sleep on money and taking some risks, what does the ratio of that look like for a 19-year-old? Like the ratio of sleep or money to sort of risk money.
As I said, it depends on the 19-year-old, but I'll give you an example of what I was doing at 19. I was pretty much speculating in stocks and so on, and I lost a lot of money, right? Because I was an undergrad and it was the tech bubble, right? What I learned from that was very important to my life now and the way I think about money now. So I actually think that at that young age, it's actually very good for you to take a lot of risk, because that's actually what teaches you about yourself, and it teaches you your risk tolerance. Because if I ask him or her now what their risk tolerance is, they actually don't know. they will tell me what they think, but they don't know, right? So at that age, to be honest, you know, your sleep well money can be 10%. Just go and explore. And it, you know, of course, if it's a 19-year-old who has already created software that they sold and now has $5 million, that will be a different recommendation, right? Because, you know, do you understand? So it really depends on the 19-year-old, but the average 19-year-old probably doesn't have that much money and just wants to try out things and start on the journey of wealth building, right? So for that person, they have so much time to learn, right? So being overly conservative, you're not going to learn anything. And by the way, when I saw your poll responses, it's reinforcing to me how conservative the investor public is, definitely. And I have to encourage people to be aware that investing is about, you know, taking calculated risk, right? So for that 19-year-old, take some risk. This is the time to do so. You know, so invest in stocks, invest in agri-finance, invest in speculative real estate, do everything, right? Because then, and as I said, it's the average 19-year-old doesn't have that much money. But if it's someone with a lot of money, you would do it differently. But the average, just explore, because that's going to teach you your risk tolerance. So you can think about stocks, right? It will also help you learn about investing stocks. There are some really good stocks that on the Nigerian Stock Exchange that you can just hold, and long-term you'll be fine, you know, versus, you know, the whole basket. If you pick some blue chip stocks, you will be fine long-term. So you want to learn about those. You can look at the top agri-finance people and even invest in some of those so that you even understand a little bit around what the agriculture problem is that we're trying to solve in this country. You can do some mutual funds as well. It helps you understand if you like that type of investing better. It's you know, when you're 19, you have much more energy than people at my age, right? So you have time to read a lot about. So honestly, that percentage, I think sleep well money should be like 10% or something, if I were to pick, you know, and then the 90% really do explore and take risk, invest, and be comfortable knowing that because you're taking the risk, you may actually end up losing a lot of it, but you will have learned a lot about yourself, a lot about your own risk tolerance, and a lot about what to do in the future to build wealth, right? So, there's nothing better than actually making your mistakes early, right? So I think at 19, I don't gate people that much. I actually think the learning is much more valuable than any very, very clear, detailed plan. You learn so much and you may actually make a lot of money, but you will likely lose a lot as well.
Fair enough. And then for Toyin, so there are a couple of questions. So firstly, I mean, so someone asked a question around, you know, I think you mentioned what you've done for your daughter and advising her to buy a house and rent it out for income. And the question is, you know, for people living abroad, how can they sort of pursue these kinds of opportunities? I mean, my suggestion would be, you know, I think we're relaunching a REIT product, like a real estate investment trust product. That could be something for them to look at. So, what do you want to answer?
Okay, sure. Look, the first thing I want to tell you is before you go into anything at all, you need to understand exactly what you're getting into. My daughter's example is specific to me and the situation that I'm in. So I live in Nigeria and I earn my money in Naira, okay? So I have 3 children in college in the US. It costs a lot of money to maintain that. So what I did is that as soon as the children were born, I started to put a small amount of money aside, you know, just to help me when they got into college. Now, my children are in college; they're almost debt free. I mean, you find out that children in the universities in the US all have loans, or well, not all, but most have loans. So my children have very little because I encourage them to also have the student loan so that at least they experience that. So the situation is, depending on where you are abroad, so it's a lot easier. what you want to do is start to put aside money and teach your children about money. It's very, very vital. Teach them about money. You see, if they can put some money aside, not just savings, put some money aside in some mutual funds, especially if you're in a place where there are good returns to the investment. Let them put a little bit of money aside, and you will watch it grow. So to get a house, you look at the environment. For instance, my discussion with my daughter was, look, she has 1 year to go to graduate. And I said, she's working at the same time. She works in a clinic. She checks in patients on this telemedicine thing. So she checks in patients to see the doctors. So she's just going in between. All the money she earns, I just advised her, take 30%, go to your bank and ask the bank what you could invest in and what are the peculiarities of those. Take another 30%, put it in savings. And she said, 30% is not enough for her to spend. I said, look, it is, because there are people your age who are not working. I give you spending money. So live with that. You will thank me later. Now, when she's done with college, she's going to look for a house, maybe $300,000, $800,000, $400,000 value. And I said, look, you got to put in 5% of that down. So I'll give you half of that. You get the remaining half, and you're set. You go to work, get a job, earn some money. The rent that you get on the property will pay your mortgage. And then you can continue to put 30% of your funds aside. And then you watch that grow as you invest that money. Situations are different. I know there are people whose children have taken loans and are maybe $40,000, $50,000 in debt. The first thing you want to do is to clear your debt. That's the first thing you want to do, because no matter how much you save, debt is just going to take away everything, and especially you that you live abroad. So clear the debt and start to work on getting your children to a place where they can put enough money aside for that equity contribution. Yeah. Typically about 5% or maybe slightly more, depending on your risk and the credit they've been able to build. But if you're abroad, it's important that your children also keep a good credit.
Yeah.
Whatever they borrow, they must consistently pay back. They must build credibility. And if they do that, they're not likely to have problems. Because if you can contribute to that equity, you let out the house, income will come from there. Don't spend the income as well, because there's a tendency to receive that income and want to spend. Take that income and reinvest it, because there will be times when you will not get a tenant, for instance, or the economy is like it is now. There's a lot of people I know in the US who cannot pay their rent. What that means is that the landlord who has taken a loan cannot pay his own mortgage as well. So you've got to leave some money aside to be able to handle such situations. That's how I believe to teach the children to move forward. And I'm doing that because, I didn't have financial education growing up. All my parents taught me was go to school, get a job, and you're fine. Get a good job and you're fine. So it's on.
So
I'm looking at it now. I'm saying I've got to give. No, that's look. If you take simple steps that won't hurt you, right now, trust me, in 15, 20 years, you will be smiling.
Thank you.
So that's what I have to say.
Thank you. So I think we're running a little bit short on time. I'll try to get to a few more of the questions. We might run about sort of a few minutes over just to get some more of the questions in. And then for any others that we cannot answer, we will sort of make sure that we answer them over email. If you have any additional questions, you can send them to our email address which we'll share later. So a few more questions. For you, Yomi, we're getting quite a few, and let me know if you can speak to this or not, actually. But there are quite a few questions in here around, should people be taking cryptocurrencies seriously? So Bitcoin and the likes, is that something that people should be looking at?
Okay, so yes, very good question. And it's a question I actually started asking myself late last year. And I've spent some time doing some research, and this is my conclusion. Yes, take it seriously. And these are the reasons why. It is new and growing. And over the next 5 to 10 years, it will make a significantly greater part of the total assets under management globally over time. Why? Today, it is primarily retail-led. It's actually retailers that are trading this. Now, it's very varied. It's going up and down. It's going crazy numbers, different. But what's happening is, I think towards the end of last year, some serious institutions started looking at it, right? And what's going to happen is institutions are increasingly going to look at it. So I've read some reports. You should take it seriously. I am starting to take it seriously. However, am I going to invest in it today? I'm not sure. So I'm giving you a balanced view, right? From the research I read, first of all, unlike a lot of other asset classes that have become quite structured, institutions have been in there. There are advisors that can educate you, that can tell you the trends that have happened. Those trends have gone through cycles, kind of like what I told you about. Crypto has not gone through that, okay? So the cycles are going to be wide swings, and there are different products that are going to get lost. So you might put your money in today and some of it might be wiped out. So they're going to be wide swings. So you should note that. But note that at a point, people were asking this question about the private equity and venture capital asset class as well. But over time, when there's been history and cycles, that has stabilized, and nobody asked that question. Is now, should I go in? Do I have the right advisors? Are there the right managers? We're not there yet with crypto. So the reason why I'm not going to do it yet, likely not going to do it, is because although I know in 5 years, I will have reason to say, oh my God, I should have entered that one. I should have bought that one. It's okay. I don't have money to lose. Today, I don't have children in college yet. I'm saving for college. I cannot lose my money today, So, and remember when I was telling you my profile, I don't have time right now because cryptocurrency is largely retail traded. Today, you have to be very careful if a manager is saying we are the experts today and we can tell you exactly what to do. So you need to take control and you need to basically do your research. And some of the research I've done has shown that a lot of the ups and downs in crypto is not fundamentally driven, but more news driven. Oh, it's going high, so we're all putting more money because it's retail. Oh, it's going low, so we're all taking money out. So because of that, you actually have to spend time and focus on it. I don't have that time. However, there's a thinking of, you know what? Unlike where I might want to put 10% of my portfolio in crypto in the future or something, if it becomes more stable, I might not mind playing with a very small 0.05 or just to see, but I'm ready to lose it. If you are not ready to lose it, and you are not ready to put your eyes on it, don't go in. So that's I don't know, you might think I contradicted. Take it seriously, but you need to determine if it's for you today. That's my response.
Yeah. That makes a lot of sense. Yes, please, Titi.
I'd love to add to that because I think we actually have the honor of being the only investment firm that has published research in this space in Nigeria. I think we're the only ones. So in July of last year, we actually did an official piece and we put it in our official model portfolios for the first time. We're the only ones so far that have done that. And we did that because, of course, we've been looking at crypto for years and we just didn't feel there was enough data until last year. And what the data showed us was that, you know, everyone is always talking about crypto, is it the new gold? We actually did the work, and it's not gold. It's not similar to gold in any way. And remember, gold protects your portfolio on the downside. That's why people invest in gold. And it helps you with things like inflation and just sort of debasement of currencies and so on. Crypto doesn't do that. So our analysis showed that crypto is very similar to venture capital. In other words, what you're actually doing is investing in the blockchain technology. And again, it's a new technology and you're taking a risk, right? But because we've actually done a lot of work on blockchain as a technology, we are believers in the technology and we think it's a good risk to take. So it would be like if you had the ability to invest in the internet in the 80s. That's what it's like, right? So it's risky, very true, but we think if you believe in blockchain as a tech and you think blockchain will be all the rage like we believe it will be, now remember it's in 10 years, not now, right? Then you can invest a tiny allocation now. Our overall VC allocation for people is less than 10% anyway. So that means we're only recommending, Yomi actually said the exact numbers, between 0.5 and 2% of your net worth, depending on if you're conservative or aggressive, right? But it is an amount, again, similar to each individual venture capital investment. You know you could lose it, right? So of course, you're not putting a crazy amount in it, but we are very strong believers in crypto. We made a call in July of last year to do it when it was at 9,000. It is now, I think, at 34 or 35. So again, it's way above our target price. It is highly volatile, so it is likely to drop back to 20. But if you're not comfortable with that level of volatility, you should not be buying crypto to begin with, right? So if you buy, so the key thing we'd like to remind people is we have a long-term 7-year view that crypto will be at, I mean, at least BTC will be at maybe 150,000 or something like that in 7 years. So yeah, you can buy at 34K, but be comfortable, it can be at 20K tomorrow, right? But again, it's a long-term allocation. You put your money in and like VC, you lock it up. Don't look at it, don't trade it. If you trade it, you will lose money. So that would be our allocation. I mean, that would be our suggestion on that.
So Titi, I might ping you to come and open an account.
Okay, may I just add a little bit to that? We're in agreement as to investing very little into cryptocurrencies. However, I think it's important to understand the technology behind the cryptocurrency that you want to invest in. I mean, there are different kinds and different bases for everything. There are some that are just based on demand and supply. But there are some that you've got to look at it. I mean, distributed ledgers and stuff like smart contracts and the rest of them. I mean, you can actually look at the value that each blockchain brings to the table. That can give you a sense of which one is likely to endure and which is not. So, I mean, if you look at smart contracts, I believe that is something that would perhaps last a good one to invest, but start small. I have done a bit of investing in cryptocurrencies. At some point, because I was just losing my mind because it didn't make sense to me. I couldn't forecast. I just took the money out and forgot about it. But it's something I'm looking at the smart contracts because it helps not just as something to invest in. It helps to build economies. The distributed ledger especially. So I think that's something that would serve in the future.
Just a quick one to add to that. I promise I won't take
long.
Thank
you so much.
In this particular instance, please be aware, we're only recommending BTC. We're not recommending Ripple or any of those other things. They're too risky. Only Bitcoin itself, because it's a proxy for the entire industry. The others are too speculative. The only other one that we think you could look at is Ether. But if you do an allocation, you do 80% Bitcoin, 20% Ether. The others, we don't have a view on those, and we think they're too risky. Just I wanted to be clear.
Thank you so much. And it seems like there's so much energy around this topic. It might be worth another future conversation. So let's watch the space. So I think just to wrap things up, I think we're slightly over in time. I'd ask each of the panelists to just take a minute, just keep it sort of brief and pithy, just to share your key takeaways for, how to, I guess, how to preserve wealth or grow wealth in 2021. Just to close out the session. You want to go first, Yomi?
Well, yeah, okay, thank you very much. Engaging conversation. I've enjoyed chatting with everybody. Look, I think a few things to take away. Number one, wealth preservation is paramount or is important to some degree. You need to think about where you are in your life phases and what your goals are from what we've said. In 2021, we've just gone through a downturn. Depending on how badly you've been hit and what your situation is, you're either, without a doubt, think long-term in your decision-making. Two, given the available investment products on the table, think diversification, but think cash conservation to some degree and ability to be able to make decisions when things start going up. Don't be in a hurry to drive growth this year. Leverage the low interest rate regime right now in any way, either restructuring or refinancing debt or accessing debt that you otherwise might not have been able to access to get something started. I think finally, start looking at alternative asset classes, thinking long-term. Private equity, venture capital, you don't have to go it alone. You can go in a pool, look for trusted, vetted advisors or managers. I think, and then maybe think about 0.05% in crypto or something.
Thank you, Yomi. Tony?
Thank you. So for me, the key takeaways would be, one, you've got to put money in the currency of your obligation. It is very, very vital. So what I mean is you have children in school who are in the UK, you've got to have some buffer in pound sterling. You cannot do without that, because there may be a time when you don't even have, even if you have the liquidity to change the money, you don't have the access. So you must have, some money in the currency of the obligations. That's one. Two, I believe that people who are doing business right now should consider growth right now. They should build capacity, because this is the opportunity they have with low interest rates. They can build capacity. If you want to change, if you need to change your equipment, this is the time to do it. Change the equipment so that it can serve you when things have gone up. In terms of preserving your wealth, I think people should diversify as much as possible. That way, if there's any untoward circumstance in one of the asset classes that you've allocated funds to, you'll still be able to live on the remaining. I look at retirees especially, and I feel for them, because a retiree who had 10 million naira was getting 1.5 million every year 2 years ago. Today, it's likely to get less than 150,000. So retirees need to look at alternative investments, and then keep some money in cash. It's very important. Cash is king, because for your health problems, health issues can come up. Emergencies come up at any time. So you've got to have sufficient money. We're talking about COVID-19 now, and from all that I've been reading, there are people who get into the hospital and they ask them to bring 10 million naira down payment before they even get treated. We're talking about gas cylinders, oxygen cylinders costing 300,000 on the rest of them. So money must be put aside in cash or near cash, so that, while you're thinking long-term, you're also living. Thank you.
Thank you so much. And Titi?
Yeah, I think honestly, everything has been said. So I'll go back to, I think the one thing that I said at the beginning that I do think it's extremely important for people is that when you are going to be thinking about managing your wealth, also think about your wealth creation framework. It's a very important thing, because if you are not clear on that, you know, you're then just doing only half the work, right? Let's not forget something, right? Most entrepreneurs, if you do end up being a successful entrepreneur, your IRR can be an amount where you don't have to worry about inflation in Nigeria, right? But it's a very difficult road. But I'm someone who definitely promotes entrepreneurship because I think Nigeria needs it. Nigeria needs more companies. I can tell you as an investor that's sitting here trying to offer investment products to clients, there are not enough products. Why? Because there are not enough companies, there are not enough things to invest in. So if we have 200 attendees here who are interested in this topic, this is also 200 people who should be thinking about, okay, do I want to be an intrapreneur within my company? Can I build a new business line, you know, or can I actually step out and be an entrepreneur as well? So that's one, because that actually leads you building more wealth. Then after you've thought about that, then be very clear on a few things. Think long-term, set very clear objectives, right? And then create a plan along with an advisor. You know, so think long-term, set clear objectives, create a plan. Those are the 3 steps, you know, and that long-term one is the biggest takeaway next to the wealth creation framework, I would say, for people. Because, you know, the short-termism actually loses money. So I would wrap with that.
Thank you so much. And I think that was my personal takeaway as well, is just thinking first about the wealth creation framework. I think it's very useful and it resonates from the comments I see with the audience as well. So thank you everyone for taking time out to be part of this webinar. We will share a recording. I've seen some questions about this via email to all the participants. Feel free to share it within your network as you see fit. We weren't able to get to all the questions, unfortunately. For the questions that we couldn't answer here, we will sort of answer over email. And for any other questions, please share them or send them to this email address, usercommunity@fsdhgroup.com. We should also flash up on the screen sort of any time now. And we will respond to them accordingly. This series, which is called Ask the Experts, will continue in February, and we'll be discussing tactics for individuals to maximize potential of managing their wealth with partners and families while maintaining some measure of financial independence. So it's a question that that we have, which is, you know, if you live with other people, which most of us do, how can you sort of pull your wealth together, manage it together while remaining independent financially? So that's that'll be the topic of the webinar in February. We will send you information about that. Finally, just a quick note that Vested, which is the product that will be launched by FSDH, will be launched, FSDH Fairpay, will be launched in Q2 of this year. And our solution will allow you to plan, pay, save, and invest in partnership with those that matter to you. So we're bringing a more collaborative approach to banking and a full suite of services to our customers. In the interim, we'll be engaging with you, be sharing perspectives such as this on how to achieve financial well-being for you and your family. Look out for our email communications, and please follow us on our handles on Facebook and Instagram at vested.ng. Thank you so much, everyone, for joining, and enjoy the rest of your day.
Thank you.
Thank you for having me.
Thank you very much.
Thank you, Obi. Thank you. Thank you, Femi. Thank you, Yomi. Thank you, Madam.
Thanks, guys. It's been fun.
Same.